Welcome once again to Triple A Professional Institutes. Um, Today again we'll continue with our lectures. We've looked at IFRS 16 in the first videos where we talked about the definitions, the overviews of IFRS 16. Please, it's good for you to subscribe to this channel as well. Click on that notification button to keep getting more video from us. Please watch the previous videos to have the overview of IFRS 16. It's a very simple standard, but a bit, having some twist in it if you don't know what to do and how to do it appropriately. So today we go straight to illustrations. It's important for you to know how to, solve illustrations. Solve questions if you are writing exams, and then if you are to prepare a report, this illustration will also guide you as to how to go about handling IFRS 16, which is called lease. Thank you. So let's go. Let's read this illustration. Illustration 1. You are the financial manager of Dangote Emefiele PLC. At the last management meeting, you were asked to use the following information to advise, as usual, on the lease contract with Tinubu APC PLC for the current headquarter building. Number 1, there is a lease payment of 100 million. Number 2, direct initial cost of 70 million. Number 3, we have incentives of 5 million. Then we have the contract period will be 5 years. And then here we have the incremental borrowing rate available to be 10%. You are required to determine the right of use of assets as well as lease liability initial measurement if payment were to be made in advance or in arrears. That is, if this lease payment now are to be made in advance or in arrears. So that is an illustration. Well, I told us in our last video that you can have your lease payment being paid in advance or in arrears, or they may not even tell you directly. Maybe in the question they will just tell you that they pay in the beginning of the year. Whenever you see something like that, what you should know is that that payment was made in advance. It has been made already for the current year. Whereas if you see that they say that the lease payment was made at the end of the year, you should know that that payment was made in arrears. Please, let's quickly go to the solution. The solution. Solution now. So what they say we should do is that we should determine the right of use asset. The right of use asset. And so in determining the right of use of assets, the first thing first, like I told us in the last video, the right of use asset. Sorry that I'm abbreviating it, but please understand it that is what it is all about. Right of use asset. And this right of use asset, in the determining, I told you, is the sum of the present value of the lease of let's say lease payments wanted to use unpaid, and because if it were to be in arrears or in advance, let's use that word. The present value of unpaid lease payment, plus if it were to be advance. Okay, let's read this way, the better way that you will have the understanding of it appropriately, so that you won't mess it up as it were. Please bear with me. So this is how we're going to go about it. Right of use of assets, since we are looking at advance and arrears. So advance and arrears. I want to give you the best way for you to understand it when you are determining your right of use asset on either the payment is made in advance or in arrears. So this is how it will be, so for you to understand it. So we have the following items that we will do. We have present value of unpaid lease payment. LP is lease payment. It will come here. If you have what we call lease payment, if lease payment has been made, you had it, lease payment. Now, lease payment that is made in advance or at the beginning of the year, that is the only one you will recognize. under advance. If it's in arrears, you will not recognize it because payment has not yet been made. Number three, you have direct 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 cost, which is also known as direct initial cost. Direct initial cost, this will come, this will come. Then you have if you have incentives, you less it from here, your incentives, you less it. Then if you have what we call cost of removal or cost of bringing the asset to the initial stage, you bring it here, and that will be the present value of removal or restoration cost. The present value, that is, if you're anticipating that the asset now or the underlying asset under consideration or is inside of this list, if anticipating that you are going to restore it back to the initial state, the cost that you will spend when it will expire, that is what we are going to give considerations to.